Welcome to Principles of Macroeconomics. Lecture 12 will cover the monetary system and monetary policy. First, we should answer one basic question. What is money? Well, first of all, money has no or little intrinsic value. Money is only valuable if it is accepted as a medium of exchange. Money serves three vital functions in a modern economic system. One, it is a medium of exchange. That means that it is an asset that is used to buy and sell goods or services, and people commonly accept U.S. currency in the exchange of goods and services in the product market. Secondly, it serves as a store of value, an asset that will allow people to transfer their purchasing power from one period to the next. And lastly, it serves as a unit of account. That is, it's a unit of measurement that is used by people to post prices and keep track of revenues and costs. Before we can understand the monetary system and the banking industry, we should take a look at how the supply of money is measured. The supply of money affects the purchasing power of the dollar. People demand money because it reduces the cost of an exchange, and increasing the supply of money relative to demand will make each dollar become less valuable. However, when the supply of money is limited relative to demand, money will become more valuable as its purchasing power increases. So the money supply is measured in two primary monetary aggregates known as M1 and M2. M1 is the sum of all currency in circulation. This includes U.S. paper dollars as well as coin, checkable deposits maintained in depository institutions, and traveler's checks. M2 is a broader measure. M1 focuses mainly on assets that we use as a medium of exchange, but M2 is also expanded to include stores of value. So it's a broader measure which includes M1, but it also includes small saving deposits, time deposits such as CDs, but we only include usually household savings of less than $100,000. And lastly, we include money market mutual fund shares. Next, we will take a look at the business of banking and the banking system. We must understand a few concepts about this industry. First, the banking industry in the U.S. operates under the jurisdiction of the Federal Reserve System, which is our nation's central bank. The Federal Reserve System carries out banking regulatory policies and is responsible for the conduct of monetary policy. We have two main actors in the banking system other than the Federal Reserve System. We have credit unions, which are financial cooperative organizations of individuals with a common affiliation. They deposit money with these credit unions, and the unions can then extend loans primarily to members, but they tend to be non-profit, and each of the depositors acts as a shareholder in the credit union, or part owner. Commercial banks, on the other hand, are financial institutions that offer a wide range of services to their customers, such as deposit accounts and loanable funds. Commercial banks are owned by stockholders rather than by depositors, and they seek to operate at a profit. One unique feature of the modern monetary system is that we use fractional reserve banking. The U.S. economy is a fractional reserve banking system, which means that banks are allowed to hold reserves of less than 100% against their deposits. So if $100 is deposited into a bank, banks are only required to hold approximately 10% on reserve. This allows banks to lend out some of their depositors' funds to borrowers in order to make a profit. As I stated before, using current reserve requirements, banks are only required to hold about 10% of their deposits in vault cash or on reserve with the Federal Reserve System. The required reserves, which I just mentioned, are the minimum amount of reserves that a bank is required by law to keep on hand to back up its deposits. Next, we need to cover bank runs, failures, and federal deposit insurance. The problem with fractional reserve system is that if every depositor went to the bank to pull out all of their deposits or their savings, which is known as a bank run, the banking system would not have enough cash to satisfy the demands of their depositors, and the amount of deposits that a bank has on its balance sheet are known as a bank's liabilities. Depositors would panic and run to the bank to try to take out their deposits if a bank was rumored to be going under or insolvent, and we observed this happening during the Great Depression in 1929. So after the Great Depression, the federal government developed the Federal Deposit Insurance Corporation, commonly known as FDIC. This is a federally chartered corporation that ensures that deposits held by commercial banks, savings and loans institutions, and credit unions. One fascinating idea about the banking system is that banks actually create money by extending loans. Banks have required reserve ratios that tell them the amount of required reserves they must hold for a certain amount of liabilities. So the portion of depositor funds that are not required to be held can be extended to customers as loans. These loans end up in other accounts, and other banks are able to extend another fraction of the deposited cash. This cycle continues until the total supply of bank deposits is greater than the initial deposit. So we can see that simply by extending loans, banks are able to expand the available supply of credit, the supply of money, beyond the initial deposit amount. The potential deposit expansion multiplier is the maximum potential increase in the money supply as a ratio of the new reserves injected into the banking system. It is equal to the inverse of the required reserve ratio. Next, we should take a look at the Federal Reserve System and how the Fed controls the money supply. The Federal Reserve has four main tools which it uses to influence the supply of money in the U.S. economy. Number one, it can change the reserve requirements. The Federal Reserve can expand the supply of money by reducing the required amount of cash a bank must hold for depositors. The banks can then extend more loans. Number two, we can have open market operations. This is the most common way in which the Federal Reserve influences the money supply in the United States. The Fed can buy bonds from banks, and this in turn increases the excess reserves in the banking system and encourages more lending. Number three, we can have the extension of loans. The Fed can extend more loans, as this will increase bank reserves. And lastly, the Federal Reserve System can reduce interest paid on excess reserves held by member banks. This should induce banks to hold less in reserves, as the benefit of holding more cash in these reserves with the Federal Reserve System is now reduced. One important distinction to make is the difference between the Federal Reserve and the U.S. Treasury. The Federal Reserve is concerned with the monetary climate of the economy. It does not issue bonds. The Fed influences the money supply and often uses the buying and selling of bonds issued by the Treasury to do so. So if it wants an expansionary monetary policy, it can start buying bonds from depository institutions and increase their excess reserves. If it wants to reduce the supply of money, it can sell these bonds and take cash out of the U.S. economy. The U.S. Treasury is concerned with really the finances of the federal government. The Treasury issues bonds to the general public to finance the budget deficits of the federal government.